Alright guys, very warm welcome to our week ahead video, with the week's video focusing on the trading week starting on the 11th of January 2021. So taking a look at the week that was, it was a week of blue waves and green numbers, where we had the first week of the trading year of the week really kicked off with a bang. We had the election runoff in Georgia, which basically confirmed a blue wave victory for the Democrats. Now, for those of you that don't know, a blue wave victory simply means that the Democrats have the presidency, they also have the majority in Congress, and even though there is a 50-50 split in the Senate after those two Georgia seats was won by the Democrats, it does give the incoming Vice President Harris the tie-breaking vote. Now, this blue wave narrative really saw quite a lot of green numbers, especially on the risk asset side, especially on the US 10-year side, but there was a few subtle surprises that we just want to make mention of. Firstly, obviously equities ran to all-time highs as expected on the hope of further incoming stimulus, and even though the move higher in US 10-year bond yields was anticipated or expected from a blue wave victory, I think the velocity of the move really did catch some participants off guard. And what we basically saw happen was that for the first time in quite a while, we actually had the move in US nominal yields outpacing the move that we had in inflation expectations, and that of course saw a little bit of a blip to the upside in real yields, and that gave quite a headache to the yellow metal, to gold, which did have a spillover effect, a negative one, in terms of the overall precious metal complex as well. So definitely a key asset class that we will be keeping a very close eye on the week ahead. The other thing to note was the US dollar. We did see some support in the latter part of the week due to that rise we had in US 10 years, but I do think it's important to view the move that we had in the dollar in context. You know, the initial move in the US 10-year breaking higher, it was more aggressive, like we said, than most market participants were expecting, and thus that change in yield differentials did play some part in the dollar's move. Also keep in mind that the dollar short is one of the most oversubscribed positions right now in the macro space, and what you normally see with consensus trades like this is that they can be susceptible to very violent pullbacks as well as squeezes. So not that I think the latest move in the dollar was really that violent, but just keep that in mind. And also, technically speaking, you know, we reached a key area of support on the charts, especially for the dollar index, going back to Jan and April 2018. So, you know, expecting a little bit of profit taking at these lows arguably shouldn't really be that much of a surprise. Now, even though rising bond yields should be something that's more supportive for the dollar, especially if it starts to really outpace that of inflation expectations, the massive amount of incoming fiscal stimulus and that ultra easy policy on the Federal Reserve side, it means that, you know, that should remain the biggest drivers for the greenback. And in the very medium term, it means that the medium-term bias for the dollar is still tilted to the downside, and the markets will probably see any type of massive rallies as opportunities to add back to short positions. Also keep in mind, as long as inflation expectations continue to push higher alongside that of the US 10-year, that should keep a lid on real yields and should keep a lid on the US dollar as well. Now, the biggest risk for 2021 for the very consensus dollar short buyers is really on the incoming data that we get. You know, right now, it seems that the consensus expects the US economy to lag that of the rest of the world, especially in places like the Eurozone and China and emerging markets. And if we do start to see the US data actually surprising to the upside and beating that of the rest of the world, that could really spark some additional upside for the greenback. And since everybody believes that it's only going lower from here, it means that it's going to be a real pain trade scenario if that starts to happen. All in all, though, you know, the political landscape right now has just cemented the market's expectations that the world will see that global synchronized recovery as well as that reflation environment in 2021, and that should be more negative on balance for the US dollar. It's also important to realize that the blue wave narrative is really simply just aligning that short-term and medium-term outlook that the markets are holding for the rest of the year. Now, going into the first half of the year, there will be very low base effects, which is also something to keep in mind. Very low base effects for things like growth or things like inflation. And if we pile on optimism about the vaccines and now more fiscal stimulus, it's really just getting easier for the market to discount any negatives. Right, so what's coming up in the week ahead? The week ahead is going to be fairly light, guys. We do have US CPI, we've got retail sales on the US side, we've also got the ECB meeting minutes coming up. I think of the three, the most interesting one will be CPI, especially as it relates back to that reflation narrative. So definitely want to keep in mind, but I think the biggest focus will be on the fiscal stimulus side. So on Friday, at the latter part of the session, we did see equity markets getting an initial boost to the upside, and that basically came from comments from incoming President Joe Biden. Now, he basically reminded markets that the relief bill that we got signed in December last year, that 900 billion one, was basically just a down payment, and that was now calling for another multi-trillion-dollar stimulus package, and that can include checks of about $2,000. Now, what he also did is he explained that he will be laying out his proposals for this multi-trillion-dollar stimulus package on Thursday. So that'll really be something very important for us to watch. There are some that doubt whether he will be able to pass something that is that's that ambitious, because there will be more fiscally conservative players on both the Republican Party as well as the Democratic side. So even though Senate is 50-50 split, and even though they do have VP Harris holding that tie-breaking vote, if they get some of the Democrats actually voting against that, it can play against that expectation. So, this proposal, in line of that blue wave we have right now, it's really going to be the very first test for the administration. And it is something that the markets will be watching closely. And the reason for that is if we see any failure, similar to what we had last year with all of that shenanigans between the two parties not being able to pass a stimulus deal, if we see something remotely similar, that could give the markets a little bit of a doubt as to the extent of the incoming stimulus that we might get. And that might create some jitters in the short term. Also keep in mind that in terms of various greed and fear indicators, Nordea Investment Bank highlighted that plenty of them are starting to hint of extreme optimism, very uniform thinking and positioning. But they also noted that right now in the very short term, it's important to keep in mind that the optimistic viewpoints outweighs the negative ones. And there's plenty of questions that's been asked right now about this reflation trade, about the hopes of that global synchronized recovery. Has those hopes basically gotten the market a little bit ahead of itself? The truth is that no one really knows for sure, but there's a few things that we can look to as considering factors for us in the short term. So firstly, unless the Federal Reserve starts to talk about possible tapering, as long as that gravy train continues, as long as the money printing continues, that will offer the market confidence that there will be a backstop in the short term. So we've seen the Federal Reserve literally throwing in the kitchen sink when it comes to policy, alongside that coordinated fiscal effort from the government. That's really done more than what was needed to give the markets, confidence that we'll see that recovery, that we'll see that global synchronized recovery, that reflationary environment, and really believe that the worst is finally behind us. So in the very short term, we have to trade with what we know. And what we know right now is that interest rates are probably going to stay low for a very long time. We know that with the incoming administration, they are planning to spend a lot more on the fiscal side. And what we also know is that just looking at the base effects going back to Q1 and Q2 of 2020, the base effects remain very favorable for us to see upside surprises in things like inflation and growth numbers in the first 2 quarters of this year. So there's really further scope for optimism to remain intact, at least until Q2 of 2020. After we have gone through Q2 though, the base effects will start to increase substantially, due to that bounce back we had in data at the latter part of 2020. And then things might get a little bit more interesting, because right now markets have been very confident that US growth will be lower compared to the rest of the world. That's been a massive factor driving the dollar lower, and also convinced that the Federal Reserve will basically stay the current course with that ultra easy policy at least until 2022. But if all the fiscal stimulus actually sees US growth surprising to the upside, that might see a couple of change in viewpoints on the Fed side. So that is that's a possible risk going into the rest of the year. Also keeping the labor market in mind, so there's been plenty of warnings from numerous analysts and economists saying that eventually the insolvencies are going to catch up for both medium and small enterprises. And that can, of course, create a lot of downside drag on the labor market. And also that whole mentality of work from home. If more and more businesses move towards working from home, it might mean that more and more of them will no longer require the same amount of staff that they usually did. And that could see the overall amount of available jobs actually deteriorate. And also, thinking of that work from home shift, what that means for the broader economy, it means that there will be possibly less and less people driving cars. There will be less people stopping on their way to work to buy a takeaway coffee. There will be less flying for work, etc. And if all of that takes place, that's really some, risks to keep in mind at the latter part or the back end of the year. So there is risks on the horizon. That is something to keep in mind. But in the very short term, at least this first quarter and second quarter, we should focus on what is right in front of us. There's a classic saying that the person who chases 2 rabbits catches neither of them. So what that means is that for us as a trader, it's good to know what might be on the horizon later in 2021. But in the very short term, let's focus on what we know. Right, so that brings us to possible sentiment shifts in a trade plan. Now, with that light calendar, guys, the main focus this week is mostly going to be on the overall market outlook for 2021, that global synchronized recovery, that reflation environment. But of course, we will need to pay attention to that incoming proposal from President-elect Biden, as well as US CPI. That can be interesting. So the trade plan for key assets in the week ahead: firstly, S&P 500, the bias remains bullish. It's a buy on dip trade plan for this one. Equity markets have already shown its hand on what it thinks about the recent developments, and they've already started the year off with quite a jolt higher, with that fiscal and monetary policy remaining very accommodative. The path of least resistance for equities does remain tilted to the upside. Broadly speaking, not only S&P 500, but broadly speaking, not only US, but non-US as well. The trend remains strong, but as with any extended market, the chance of sharp corrections are always possible, so just do keep that in mind. In terms of WTI, the bias again remains bullish here, buy on dip trade plan. The rally in oil markets have been, nothing short of spectacular. We've been really bullish on oil going back to November 2020, and the move higher has been mostly driven by, there's plenty of factors. We've had the down dollar, we've had better supply and demand expectations, we've had the recent OPEC plus developments, better than expected inventory data, and then of course that overall global outlook for 2021. So the trend once again remains strong here. But like we said, sharp corrections are always possible, so definitely keep your eyes on your fries there. The US dollar, like we said, bias remains bearish. It's a sell on rip trade plan. The move in the US dollar this week, it was a warning sign, for markets, that markets don't move in a straight line. We do need to be mindful of the possibility of pullbacks, but pullbacks in any type of trend is both healthy and necessary. Technically, we know that we've entered into a key support zone, so we are keeping a very close eye here on that US 10-year in the week ahead. If that sees a further push to the upside, it can continue to offer some solace for the US dollar, but we would still expect any significant rallies to be made with sellers, especially against those pro-cyclical currencies like the Aussie dollar, the Kiwi dollar, and the Canadian dollar. Coming on the fixed income side, US 10-year, the bias for US treasuries, especially on the back end of the curve, remains very bearish. It's a sell on rip trade plan. Now, the sell-off we had in US treasuries this week alone, it's been nothing short of spectacular as well. So, what we do need to keep in mind is that it is being driven by that reflation hopes, getting a shot in the arm from that blue wave, but the move is arguably looking a little bit overextended here in the very short term. So just watch this one closely in the week as well, especially with CPI data coming up. All right, guys, so thanks for listening. Thanks for watching. Any questions, please don't hesitate to let us know. And I hope everybody will have a fantastic trading week ahead.